In this module, I demonstrate the calculation of IRR, the internal rate of return, which is a capital budgeting technique, via the use of a financial calculator in the emulator mode. In this particular case, the calculator is the Texas Instruments BA2 Plus. The basic theory of the internal rate of return is you have a series of cash flows and a cost today, and it is the discount rate that forces the present value of inflows to the cost. So the present value of these inflows should be equal to the cost. The rate at which that equilibrium is attained is the internal rate of return. It is also the same as forcing the net present value equal to 0. The net present value formulation is given as such, and for net present value the R is given. The difference is, for the internal rate of return, the R is actually the variable, it's not given. So you have the cash flows, you have the number of time periods for which the cash flow occurs. What you don't have is the discount rate that will make the left hand side of this equal to 0. Now that introduces a little bit of computational just tediousness, and if you do it by hand it becomes a little complex, but using a calculator it can be done very easily. So the basic timeline setup of this is like is this. So if you have $100 cost and the cash outflow is $10, $60, and $80, on a timeline this is represented as your cost minus 100 and your future cash flows, which are inflows, is 10, 60, and 80. So you want to discount them and you want to add these entities, and the rate at which the sum of these will be 0, that will be your internal rate of return. So to do this, we use the calculator. You hit cash flow, and you notice that there are some values there already. So you can clear it not by hitting 0, but by hitting second clear work. Second clear work. You can use the down arrow buttons and you'll see that the fields are empty, which is what we want. So let's enter 100 with a negative sign. The negative indicates that it's an outflow or a cost. Remember to hit the enter button. If your calculator accepts the entry, a little triangle shows up. Hit the down arrow and there's your first cash flow, $10. Hit enter, down. Now you see F. We are not going to use F in this example. F is the frequency of a particular cash flow. In this case, the default is 1. That means there was one cash flow of $10. C02 is 60. Hit enter. Frequency again 1. Continue. And C03 is 80. Hit enter. It's down arrow 1. Now something interesting will happen. C04 shows up as 0. Please do not hit 0. Do not hit enter here, because that is like telling the calculator that the fourth cash flow was $0. That is not the case. So just go hit the down arrow button, this one here, and we will see F, F04. That means the frequency of the fourth cash flow is 0. The translation of that is that there are 0 occurrences of $0. Hit the down arrow button again and you'll come back to your initial cash flow, which in this case is minus 100, which is your cost. Always check your entries, garbage in, garbage out. Minus 100, 10, 60, 80. And so we are done here. If you want, you can clear the screen, not by hitting second clear work. That will actually clear the values you have entered in the cash flow register, is called. You want to hit just CEC, which is clear entry clear. And you have a clear screen. This calculator has a dedicated IRR button. That's this one. Hit IRR, and notice you actually cannot go up and down in this function because there's nothing to enter. We are actually calculating for the discount rate that will make the present value of the future cash flows equal to 0. So all you have to do is hit the compute button, which is CPT on this calculator. And 18.1258 is the answer. The star indicates that is the output. Notice the IRR is actually a percentage value. The NPV is a dollar value. And so the IRR is actually 18.13. Ignore this 10. Doesn't mean anything on this particular slide. So the internal rate of return for this series of cash flows is 18.13%. That concludes the demonstration of the calculation of IRR via financial calculator. This is Pank Agrawal, PhD Finance, giving you a tutorial on this.